Wall Street has just broken the US housing market in a shocking turn of events that could see the largest institutional investors abandoning the housing market in a stunning exodus. Billions of dollars are in play here, and we're seeing substantial shifts in asset allocations amongst these investors that could have massive consequences across the entire real estate market. Today I'll be diving into all of the recent market activity that's been taking place, uncovering the reasons for this unprecedented move, as well as what it means for the overall housing market. So the housing market really went through a boom period during the pandemic, in which there was a flood of institutional money coming in to buy homes. Low interest rates, easy access to capital, rising rents, and skyrocketing home values were too much of an attractive deal for many Wall Street firms, including the likes of Blackstone and iBuyers like Opendoor. However, all of this has come to an end, with most of Wall Street no longer buying homes and in many cases starting to sell off their real estate portfolios in anticipation for a devastating housing market crash. Now, according to John Burns Research and Consulting, home buying activity amongst iBuyers and the largest institutional investors is down close to 80%. And Invitation Homes, a $20 billion real estate investment trust who owns the most single-family rental homes in the US, have recently slowed right down on their home buying strategy to the point where they are now a net seller. And in Q1 of 2023, they sold off 297 of their homes while only buying 194. Yes, that's right, the largest US rental homeowner is selling more homes than they are buying right now, sending a clear signal on the direction that they believe the market is heading in over the next year or so. And there is a big difference between their buying activity now compared to a year ago in Q1 of 2022, where they bought 822 single-family homes while only selling 147. And in similar fashion, another REIT in American Homes for Rent, who are worth $12 billion, have also slowed right down on their home buying strategy and have also sold off more homes in the last quarter compared to those that they have bought. These two multi-billion-dollar real estate funds clearly aren't satisfied with the risk-to-reward ratio on homes right now, and the current yield available on rental homes is nothing special, especially considering the downwards pressure currently being applied to home prices. And I'll touch more on that in detail later on in the video. But probably the most alarming pattern of investor activity taking place recently is that of Blackstone, the asset management giant who are seeing rapid withdrawals from their $70 billion real estate fund. Now, the Blackstone Real Estate Income Trust, known as BREIT, saw investors request to redeem $4.5 billion of their cash from the fund in April and a similar amount in March as well. In a somewhat similar fashion to a bank run though, Blackstone could not pay out on these withdrawals and limited the amount of withdrawals that they would redeem to $1.3 billion, which is just 29% of the requested sum. Now, Blackstone's fund had made big investments in apartments, student housing and warehouses, and has taken on new cash at a rapid pace in recent years. However, just like the general real estate market, the fund has declined in recent time and achieved a negative performance for Q1 of 2023. Now, investors are running for the door and turning to safer options that offer a very competitive yield, like bonds. We've also seen disastrous results for companies operating iBuying sectors, including the likes of Opendoor and Zillow, who were once Wall Street golden boys in the fintech space. Now, these companies were partly responsible for driving up home prices to the peak of the bubble, overpaying on thousands of US homes in an attempt to flip them for more money. Now, this shambolic strategy resulted in massive losses as the firms were forced to sell most of these homes for a much lower price than what they bought them for, and we even saw Zillow put an end to their iBuying program altogether at the end of 2021. And although Opendoor has not closed their iBuying program completely, they have certainly slowed down in the speed at which they were buying homes, and that can be seen by the layoffs that they have been making recently, announcing that 560 people will be losing their job, a 22% cut to their workforce. Opendoor did make a loss of $1.4 billion in 2022, more than double their 2021 loss, despite doubling their sales. And at the end of 2022, they had 13,000 unsold homes out of the 35,000 that they had bought that year. And as you can see from this chart, the areas that Opendoor have been operating in have seen significant market declines from the peak, many of which have fallen by close to 10%, and that's not even taking into account Opendoor overpaying for a lot of their purchased homes. And by looking at the stock performance of Opendoor, I would speculate how much longer that they can continue to even operate as a business, and bankruptcy or a takeover is not out of the question if the real estate market continues to decline. On top of all of this, we've also seen Wall Street banking giants like Morgan Stanley and Goldman Sachs come out with bearish comments about the US housing market relatively recently. Now, Morgan Stanley are predicting US home prices to fall by 4% in 2023, while Goldman Sachs believes that the decline could be as high as 6%. Now, both of these predicted declines would mark an extremely sharp decline in home prices relative to historic downtrends. And perhaps the most bearish prediction coming out of these Wall Street giants is from KPMG, who expect US housing prices to fall by 8% in 2023. So with all of these Wall Street giants and large institutional investors slowing down their activity or leaving the market altogether, they must be leaving for a reason. And I think it's clear that they are not confident in where the market is set to head in the coming years and are fearful of poor returns across the real estate sector. We are already seeing rents slowing down in recent months, meaning that each home is now generating less cash on average compared to last summer. Now, this is obviously not an appealing thing to be seeing for these investors, especially when you factor in the risk to their capital by owning these homes right now. The truth is that the real estate market really has not fallen enough just yet to make the risk to reward ratio of investing in it attractive enough. From the peak back in June of 2022, the Case-Shiller US National Home Price Index has fallen by a measly 2.8%, which is a long way off the sort of declines that many investors and analysts are expecting to see. There are a number of economic conditions that have also changed since this peak last year, and many of them do point to a much steeper decline in the housing market. The home price to median household income ratio perfectly displays just how expensive housing is in the US at the moment relative to all other periods in history. And as you can see, the ratio being 7.54 is now even higher than the peak of 7.03, which was seen just before the global financial crisis, which is a very concerning signal to see. And it's also significantly higher than the 5.69 ratio at the start of 2020 before the pandemic. And to add to this, mortgage rates are still sky high, meaning that homeowners are not only paying eye-watering prices to actually buy a home, but they are also faced with the highest mortgage rates that we have seen since 2008. Now, this is making housing so unaffordable right now that it is almost certainly unsustainable in the long run. And this housing payment to income ratio does also show quite well just how high the percentage of average household income is being spent on housing at the moment. The pressure that homeowners are under to afford to not only buy a home, but also to keep funding their monthly mortgage payments is without a doubt something that is concerning to large Wall Street institutional investors. They are most likely looking at the current market conditions and thinking, how much higher can house prices really go over the next few years, given how much consumers are struggling right now with affordability? Especially knowing that the Fed is carrying out quantitative tightening in which the M2 money supply is shrinking. A contracting money supply in which money is being taken out of the system is definitely not a good thing for asset prices like real estate and stocks. A declining money supply tends to have a number of negative knock-on effects on the economy, including less money being available to buy goods and services, lower corporate profits, more layoffs, and higher unemployment. Now, the money supply is highly correlated with house prices, which means that we can expect to see home prices decline as the money supply declines. Taking a look at this chart to see the correlation between the two, you can clearly see the sharp surge in the money supply in 2020, which led to house prices following. Now that the tables have turned though, with the money supply contracting, we are seeing home prices follow this downwards movement too and continue this correlation. Quantitative tightening is likely to continue for some time due to all of the excess money that is currently in the system as a result of rapid money printing during the pandemic, and it does need to be gradually taken out. And this would clearly not be a good thing for the housing market and would put continued downwards pressure on home prices. It's not just the housing market that is in trouble though, and in fact the US could be facing a severe recession in the near term or potentially complete economic collapse. I go into the details in my recent video, which you can check out by clicking on the screen right now. Aside from that, please do leave a like on the video if you enjoyed it, that does help out a lot. Also be sure to subscribe for more, and thanks a lot for watching.